Tuesday's market closes higher in the grains, mixed in the livestock futures. Joining us, Brad Koima with Koima Varlick. Brad, let's start off talking about live cattle futures. A nice update here today to start with, as we scored new contract highs and like Dees on back and then kind of faded. What happened?
Well, first of all, thanks again for having me on. I always enjoy this, Michelle. To reflect on what went on here, I thought, we had a solid day fundamentally, news-wise. I thought the cash market in my neck of the woods, which is Northwest Iowa, we traded quite a few cattle at 145. Those same kind of cattle probably were worth 143 last week, so that's a good sign. And not exactly the kind of cattle, and a pen of my cattle trade that way, but colored cattle, not super fancy. I think by the time you get, later in the week here, you're probably going to hear some 146 trade on some of those real premium kind of cattle. So a couple of things I liked that we've been doing the last couple of days, and it has to start with this huge slaughter. Last week, the first 2 days of this week have been very, very big. I'm inclined to think that the Packer isn't going to kill this many unless he's got a good reason, right? So he's got meat sold.
They must be making some money.
You're right. The the broader view here, you and I have visited about this before. My opinion is that the fourth quarter of the year has got potential to get kind of exciting, and some of that's because we've changed some of the seasonality of the market. We've moved cattle in the south that would have been September and October cattle. We moved those into the summer. They're long dead. And that happened because of the drought there. There was no wheat pasture. They had to go on feed. They grow faster on feed than they do on pasture. That was part of the whole problem with the regional imbalance in supply through the summer. Now in the north, when we typically have these long-fed calves, here you're sitting here as current as we were since 2014, at least in my part of the country. And that's because of the cost of gain. And because of the heat and all these other reasons. So we're very current, and I think the supply of cattle is less than what the larger trader views is. So I'm anxious to get into the fourth quarter and see where we go.
What are you thinking about the cattle on feed report coming up on Friday in terms of those placement categories especially?
Boy, that placement thing has gotten a lot of publicity, hasn't it, now for the last several months? We keep thinking, well, we got to be getting to the end of this deal, right? There is enough, there is enough drought problems yet in a few areas. That's maybe prompting some placements that would have otherwise waited. But I'm going to go out on a limb here a little bit. The trade guess is not real glamorous, right? I think that we can beat that trade guess a little bit. And don't forget about the other part of that report, which I always thought was the biggest thing on a monthly report, and that's the marketing number. Looks like a monster marketing number, and it should be, too, based on the heavy slaughter that we've had.
So a lot has been made as well about this 17-month low in choice boxes, but when you look at the load count from last week, it was one of the highest weekly load counts since, I think, mid-July. So we must have some good underlying demand here at these lower prices.
Well, I think you and I are the only one on this team then, finally, okay? I mean, everybody else that asked me about it, they seem to have this perception that, oh, boy, this beef thing is not in very good shape. And I see it like you do, Michelle. I think they don't kill this big number unless there's a reason.
Right.
The people that I talk to tell me that the boxes are done going down. And that would be pretty seasonally normal. I also hear that there's good business for, 30, 60, 90 days. That would tell me that there's, in spite of worries about recession, in spite of all that stuff, that there's still some basic, good, solid domestic fundamental demand. And, of course, exports have been pretty solid now, too, for several weeks and months in a row, too. So I'm not in that camp that demand's bad. If it was, we wouldn't be killing 128,000 a day.
Yeah, and like you pointed out earlier, the market has been really resilient here with some of the outside market economic negative factors that we have seen. So let's move over to the hog market. What do you think there? October, obviously, pretty much in line with the index now, but the back months still at a discount, but above where we historically are for this time of year. So where do you go now?
Well, the hog market is, there's no market that's easy to trade. Let me say that. But the hogs would be one of the ones that are the most difficult, at least for a guy like me. This is what I have a hard time separating my fundamental orientation away from the hog thing. 6, 7, 8 months ago, you couldn't access pigs. Okay, well, there's a hog building. You've been here. You can't swing a dead cat without hitting a hog building around here, right? So you couldn't get the building full because of disease problems. Now you're flooded with feeder pigs, right? I mean, literally. So the supply to me has got me thinking, okay, be careful, be careful, be careful.
Right.
We've had a nice rally. We've gotten overbought. We've gotten, frankly, further than I thought we would have, Michelle. But if I was a hog hedger, and I am, I would be sensitive here to taking advantage of this last rally. Obviously, China's a big part of that whole component of whether demand will stay good, and I don't know what's going to happen over there. Hopefully, nothing. But I think you're going into a heavier supply here going into the fourth quarter and first quarter next year, so I'd be careful.
China's pig prices or hog prices have been really high, so maybe they'll come back in for some more U.S. pork. Let's hope for that.
Well, they like the recession. The hog trader seems to like it when you talk recession because the sense is that the demand will improve for that economically priced cut. So
let's talk about grains here. Obviously, the corn market got help from this big push in wheat, which was triggered here by some of these Ukrainian regions saying they're going to maybe try to defect and go with Russia. But let's just talk corn because it got up into areas that we hit in resistance on the charts right around when we had the report last week. Can we take those out eventually here or not?
Eventually, I'm going to say yes. In the short term, I lean toward thinking no. The timing doesn't seem great for that to me.
Right.
If it were the middle of October rather than the middle of September with a little more harvest in our back, in our rear boom window, I maybe would feel a little better about that. I struggle with buying it against the highs at 690 something in the middle of September. And this time of year, the other thing you hear a lot of is all this yield talk, and there's been some basis adjustment. There's some demand worries here from the ethanol industry. I mean, look at crude oil in the low 80s. So I'm probably not that raving bull that some others that you may visit with here later on. I could see that we get into next year. If I was an end user, and I am, I would certainly buy breaks in the July corn to make sure that we don't have the same thing happen to you that happened this year. But I think we're a little ahead of ourselves here and probably need a little more reason than just because wheat was up 50 cents, right?
Gotcha. Thanks so much for joining us, Brad Koima with Koima Varley.